Now, you don't hold a position in the futures market long term because it's expensive. You're usually using a lot of leverage. This is a trade, a flip. So if everybody in the futures market thinks, hey, something's going to go up, they buy futures. Of course, it's self-fulfilling. They drive the price up, right? But then the problem is, now what? Once everybody's in, everybody's in. And if there isn't real physical metal being purchased and stacked and set aside and taken out of the market, the price is going to blip right back down.
Hello everyone and welcome to another edition of Triangle Investor Interviews. I'm your host Lucian Valkovic, and before I announce my guest, just a quick reminder of a disclaimer. This interview and all my interviews are not a recommendation to buy any shares, products or services. Always do your due diligence and consult with your financial advisor. And my guest today is Keith Wiener, an economist, gold expert and the CEO and founder of Monetary Metals, somebody that I always enjoy listening to. Keith, welcome back.
Thanks for having me.
My pleasure, Keith. Let's start with the monetary metals and sound money environment. Silver's role in wealth preservation. You recently noted on X, I saw your post on X, that silver has a high stocks to flows ratio, suggesting it retains monetary characteristics despite industrial uses. So could you elaborate on how silver compares to gold to a store of value in today's economy? And what practical steps should investors take to stack physical metals efficiently in this unsustainable financial environment?
First of all, what I mean by stocks to flows is the total above ground inventories of silver in human hands divided by the annual production. Now, most people think of supply and demand. The more supply goes up, the more that price would go down. The more demand goes up, the more price would go up. And so they're trying to find, it's almost like they work hard to find a way to say, XYZ is becoming scarcer and therefore more valuable. So we're consuming all the silver stocks and therefore the silver price is going to rise. That's not how you would expect money to behave. Money should behave that people just desire it. And if people desire it, that means they're not consuming it, they're holding it. And when the miners produce more, there's a demand to hold more. The demand for money shouldn't fall off. And if it does, if you have a good where the demand falls off as the supply rises, maybe that good isn't money. That was one of my arguments in my Bitcoin debate with Pierre Rochard a couple of years ago. So silver still has a high stocks to flows ratio. It's not as high as gold, but it is still a very high stocks to flows, which means it still has monetary characteristics. People still hold it for non-consumption purposes. Now, when you say, okay, what's the most efficient way to preserve your wealth using precious metals? The thing that silver's always had, and it's still true, is if you're working for wages, and let's say you're a skilled machinist or a plumber or something like that, and you're taking home $1,000 a week, maybe, if you're good in the U.S., and the rest of the world it would be quite a bit lower, I presume, and you want to set aside 10% of that wage, you're buying $100 worth of metal. Well, $100 worth of metal is more than 2 ounces of silver. 2 ounces of silver, you're going to feel that in your hand. That is a couple of chunks of metal. Gold, that's like a gram. And gold being so dense, a gram is a tiny little wafer. It's smaller than most people think it is, unless you've seen it. So that's problem number one. Problem number two, to machine something so precisely as that is expensive. And they come in these certicars, which are expensive. So if you want to put $100 into metal, gold may not be the most efficient thing. You'll see wider bid-offer spreads on these tiny little 1 gram or half gram, products than you would see on, let's say a 1 ounce, silver bar or silver round. And so silver, be more efficient. Now, what's interesting at the moment, and just before we came on air, I said this market is not behaving the way so the silver price peaked in, was it March or April of 2011? And the gold price continued to drift slightly higher, and its peak was August of 2011. Since then was the endless dark days And people called me a perma bear because every time the price would blip, the gold people would scream breakout. And I said, it's a Jedi mind trick. This isn't the breakout you're looking for. And this market isn't behaving that way. So at that time, every time the price would go up, we would see the gold basis rise. And the basis is a measure of the abundance of some commodity to market. Abundance going up with price going up is not usually a good sign for the price to be durable. So what that means is every time the price is going up, it's people in the futures market that are buying it. Now, you don't hold a position in the futures market long term because it's expensive. You're usually using a lot of leverage. This is a trade, a flip. So if everybody in the futures market thinks, hey, something's going to go up, they buy futures. Of course, it's self-fulfilling. They drive the price up, right? But then the problem is now what? Once everybody's in, and if there isn't real physical metal being, purchased and stacked and set aside and taken out of the market, the price is going to blip right back down. And that was the pattern again and again and again from August 2011 through 2018 into 2019. That's what happened. And Pavlov's dogs have been trained, don't buy the blips and metals because then it's going to come right back down and you're going to have egg on your face with your wife. You're going to lose money. It's bad. This isn't happening now. And so I just looked at our chart, and I can share, if you want, with your viewers a picture of the silver basis. So the silver price has obviously risen up. And with that, what we see is a rising co-basis in silver, which means rising scarcity. So we have rising price, and the metal's becoming more scarce to the market than it had been before when the price was lower. That's very interesting because it tends to suggest this price move is durable and probably has some more legs, left to it. Now, I totally get the argument, and everybody in the trade, who's been here for more than a few years says, look, nothing runs in a straight line, nothing goes parabolic forever, we're probably due for correction. And that isn't necessarily wrong. I'm not a technical analyst. Maybe we're due for correction, maybe not. Sometimes this time of year you can get strong prices. Sometimes things can turn. But I can say that the fundamentals are looking especially in silver, strong. And the fundamentals in silver are stronger than they are in gold right now. And gold has obviously been the main star of this whole thing. I don't think we touched 3,700 yesterday in spot, but I think we got real close to it. And, backed off now, obviously, down in the morning trade. Silver is very interesting at this moment.
Agreed. Keith, looking ahead, what shocks do you anticipate on the silver and gold market? Do we have an elephant in the room for both of them?
I think we got past tariffs in the U.S. I think we have clarity on that. But, of course, that's one of those genies. The genie's out of the bottle, and you can never quite tamp that genie back down into the bottle again, can you? And, that damages trust a little bit. And so could the market move out of the U.S.? Could people become less trusting? Who knows what's going to happen? Could traders become more reluctant to make a market in these metals? I talk about this so many times over the last 15 years. The basis trade is buy spot and sell future and pocket a little spread called the basis trade. But that is in effect buy London and sell New York, which relies on your ability to take delivery in London, ship it across the Atlantic Ocean or fly it, and then deliver it into New York. And then tariffs means you can't deliver it into New York, at least not economically. So, I think that shock is done. But now I think we head into the reversal of interest rates as they slam back down to zero. Now, I think they have to go to zero anyway for other reasons, economically, and I've been very vocal in that for a long, long time. But we now have Stephen Mirren apparently confirmed by the Senate to become member of the Federal Reserve Board, and Trump wants zero interest rates. And so Trump is pretty good at getting what Trump wants. I think it's actually going with the grain. It's going with the flow anyway. And so I think we're going to see a return to shockingly low interest rates in the United States. Now, that can't possibly be anything other than bullish for metals. Is that already discounted into the price of the metals? I don't tend to think so. Maybe there's some people that are buying it in anticipation of that, but At least, if Twitter is any, or X is any indication, I don't think most people are with me when I say interest rates are going to be slammed to zero. So if they are slammed to zero, when they are slammed to zero, yeah, I think the market's going to be a little surprised by that, and that is going to be bullish, for gold and probably silver as well.
Yeah, that would be bullish for gold and silver. However, how would that affect the economy going forward?
So the problem with any kind of central planning thing, let's say you take a rent control law, let's say you take a minimum wage law, you always have all these companies and people lined up on one side saying, yeah, more. And then you have people lined up on the other side saying, that's killing us, that's strangling us. And so, the minimum wage debate, you have employers, especially of low-skilled people, saying, you're killing us. Then on the other side, you have unions. Not that the minimum wage workers are members of unions, but the union pay scale is very often indexed to the minimum wage as a multiple. Apprentice plumbers get 3 times minimum wage or whatever. It's the same thing with the interest rate. You have all of the parties that depend on earning fixed income on their very substantial assets that want higher interest rates, and that would be insurance companies, certain parts of the banking sector, certain kinds of certainly fixed income funds, annuity, people that run annuities, companies that sponsor their own pension plans. Everybody's going to want higher interest rates. And on the other side are all of the business borrowers that are in this boat, and it's a very destructive dynamic. But we had 41 years, 1981 through 2022, of falling interest rates. And every time the interest rate falls, think of the interest rate as the cost of capital. And every business, let's say you're a hamburger restaurant, let's say you're a property developer building apartment buildings, doesn't matter. Every business is looking at cost of capital, and they always have a marginal project in their back pocket. Marginal meaning it's at the margin, it's the one that you're not building. And then the interest rate ticks down, and there's only one, now the project is doable. And there's only one reason why it's doable, is because the interest rate is cheaper. And this happened again and again and again and again for 4 decades of falling interest rates. And I'll use the term suckered everybody in. They're not suckers. I mean, there's only one interest rate to deal with, which is the one in the market. So the market rate is lower. Your spreadsheet flips from red ink to black ink. You do the project. And so we've built so many hamburger restaurants. We've built so many factories that produce hamburger grilling equipment. We built so many factories that make those awful ceramic tiles they have on the floors of the lobbies of the fast food restaurants and the plate glass windows and all the drive-through, speaker systems, the whole thing. And you can't reverse the interest rate. All of that business that was enabled by the falling interest rate is destroyed, and has to be liquidated with the rise of the interest rate. So if you want to have rising interest rates, you're going to have to liquidate enormous swathes of the economy, which I don't think anybody has any appetite for. So the interest rate's got to come down anyway. And then on top of it, Trump wants to do this. But the problem is you're producing ever more marginal projects that generate ever less return. So I wrote an article, I think one of my more important ones, but very underappreciated, called The Heat Death of the Economic Universe. Looking at this diminishing return. We have exponentially growing debt. It grows faster and faster and faster. And at the same time, it is producing less and less and less. It takes more and more borrowed dollars to get the same amount of juice. So ultimately, it leads to the death of the economy. But in the short term, juices up a hell of a boom, and that's a lot of fun.
Yeah, that's a good point. If I remember correctly, you've criticized proposals for executive influence over the Federal Reserve, likening the Fed chair's role to an impossible central planner with specific reforms. What specific reforms, if any, do you believe could improve the Fed structure or its entire concept of central banking?
I think we should have a free market and money and credit, which is, both simple and most people would say that's, unacceptable. But, if you're going to have a central bank, I guess there are degrees of bad. And one very high degree of bad is to impose an irredeemable currency via legal tender laws and taxation and all these things, and to have that currency borrowed into existence by a central bank. That's really bad. But even worse than that would be to have a pure fiat currency printed into existence by the legislature. And even worse than that would be to have a pure fiat currency printed into existence by the executive. So their degrees are bad, and I definitely don't like the idea of the executive, pushing, people say, well, that politicizes the Fed. Okay, sorry, when you socialize something, and sorry, the Fed is the socialization of, the most important credit decision. When you socialize something, that is to substitute a political process for a market process. You're taking it out of the realm of economic decision-making by the market participants and turning it into a politicized political football. That is a feature, not a bug. That's why they want it. So to say, well, okay, now giving the executive control over it politicizes it. No, it's already politicized. But the difference is you have one individual, controlling it for the whim of the next election versus a governance structure that none of this is good, but I guess it's less bad. It has a little more stability. It's a little bit less likely to twitch and jerk with each political, wind shift. And, what you want is, stability and not rapid changes in interest rate or, monetary.
Right. There is a danger of social security and US dollar could fall simultaneously in the same package. What are the key warning signs investors and policymakers should watch for, and how would a transition to a gold-based monetary system mitigate such a collapse?
I mean, when the thing's ready to collapse, I don't think anybody can mitigate anything. I think it's kind of like Humpty Dumpty, in the old fable. You have all of these guys standing around in armor with swords and shields and all these horses stamping their hooves and making noise in the morning sun. They can't really do anything about a broken egg. But that said, the dollar system is wired the way it is. And, it's not going to change and not going to suddenly... So when people say the dollar falling, do they mean falling relative to other currencies, primarily the euro? Are they looking for the dollar index to fall? Because if so, the euro is subject to all the same problems that the dollar has, and then some. Much more severe political problems, because the Eurozone is not really, the European states, if you want to call them states, are not at all equivalent to the U.S. states. They don't have a shared language, they don't have a shared culture, they don't have a shared economy, really. Or do you mean the dollar is going to fall against consumer goods? And my argument is you can't really use consumer goods to measure economic value, because the value of consumer goods is bangs around all over the place, and for many non-monetary reasons, such as tariffs. But the dollar is falling as against gold. So, not too long ago, we had, the dollar was 16 to 18 milligrams of gold. The price of the dollar has now fallen. It's 8.4 milligrams as of yesterday. So, the dollar, continues to fall. That's not good for anybody holding dollars. The people who hold gold think it's good because they're measuring the gold in dollars rather than measuring the dollar in gold. They should be saying, we avoided that collapse. We didn't lose our savings, but they're thinking they're getting rich. Not exactly. But, warning signs in general are capital erosion. When you see that it's possible to muster a multi-billion-dollar budget to build a brand new glorious palace of some sort, but you can't muster the maintenance budget. So 5 years later, you notice the rust, on the exposed metal that's not being repainted. You notice the rot on the wood trim that's not being maintained. You notice the elevators that have to run at a much slower speed because the track is not safe at the high speeds anymore. The escalators creak and squeak. Metal is galling. All these signs are indicating that the capital isn't being maintained. And that's ultimately what causes a currency and a social system.
Right. Let's return to the tariffs. You mentioned it briefly. I want to hear your take, given the ongoing debates about protectionism. How do tariffs disrupt the free market principles you advocate, and what would a sound money framework offer as an alternative to such policies?
Ultimately, you have three kinds of things that want to move across borders. And when they do, you have peace and prosperity. You have people that want to move across borders. So we now have the spectacle of not only arresting people in the United States, but in some cases very violently arresting them. It seems, and maybe this is a caricature, and maybe this is unfair, but it seems that sometimes they prefer to, when they pull a driver over, they prefer to smash his window and rip him out of his car by his arm, dislocate his shoulder, beat the snot out of him, tase him, spray him with pepper spray and tear gas, chain him at ankles, knees, waist, elbows, and neck, throw him in a cell, and they don't let him shower for 3 days while he has all this tear gas and pepper spray all over him. They'd rather do that than just arrest him the ordinary way while they wear, anonymizing, face masks. So people want to move across borders for economic opportunity. If you stop that, then that means you're stifling economic development. On one side, you have a guy who's starving. On the other side, you have a would-be employer who can't get the workers at the wage. And so maybe you get poor service, maybe you get restaurants or other things closing down. You certainly get a whole lot of consumers who can't afford certain services because, you drive up the prices. So that's the first thing that wants to move across the borders. The second thing that wants to move across borders is goods. There's been a lot of discussion of could you manufacture iPhones in the United States? And both Tim Cook, before when Steve Jobs was around, my understanding is Tim Cook was running the supply chain side of the Apple business. So here's a guy who understands procurement, who understands logistics, who understands what it takes to manufacture 1 billion units of something. And Tim Cook is saying, look, you don't have the workers in the United States that want to assemble all these things and turn all those screws. You don't have the supply chains. You don't have the whole ecosystem to manufacture that kind of product, at scale. You have little labs that can make, 100 of them, but you don't have that kind of thing. So if you say, okay, we're going to block the import of goods, what that means is then, iPhones either become totally unavailable or the price shoots up. How does everybody feel about a $10,000 iPhone instead of a $2,000 iPhone? Is that good? Who is that good for? Maybe the importer would like it, but not too, it's not helping Apple, it's not helping anybody. Now, if you measure the dollar in terms of consumer prices, you say, wow, we've had a lot of inflation. Right? The dollar has gone down. Well, has it? Or is it just the government just taking this giant tariff on importing iPhones, forever? The third thing that wants to move across borders is money. Money moves across borders for a lot of reasons. It moves across borders to buy things. It moves across borders to lend, to finance something. And it moves across borders to make, investments. If you block that, then on one side you have money seeking return on capital and, not getting it. And on the other side you have capital projects that would be good projects that languish and die because they can't get the financing they need. So every time you interfere, there's always some political slogan that says, look how good this is going to be. If we pass a $25 per hour minimum wage, look at how much more money the, poor unskilled workers are going to get. That's not what you get. What you get is unemployed, low-skilled workers. It becomes illegal to employ them. You're not paying them more than they produce. You're just not paying them at all. You have to let them go. And businesses close, and other people are laid off, including higher value, people. And very few people stay minimum wage their whole career. That is a stepping stone, the first step in the ladder as they move up. And now you've deprived them of that first step. Well, how are they supposed to get to the second step?
Yeah.
It's just a bigger gap. So everything you do, you're promising political sloganeering. It makes people feel good. Or some constituents feel good at this stuff. You're not accomplishing what you think it is. You're just making life harder for everybody else. And very often in ways that are hidden and indirect, that they don't really trace. I always wondered, with something like trichinosis, how did people in the ancient world understand that some religions ban the eating of pork? Was it because of trichinosis? And I kind of wonder, how could it be? Because if you eat a pig and you don't cook the meat properly and it has the trichinosis, there's a cyst in the meat, right? If you eat that, by the time you notice symptoms, it's like 3 or 4 months later, is my understanding.
Yeah.
How would you associate that pain in your shoulder with something you ate 4 months ago? In the ancient world, remember, they didn't have the germ theory of disease. They didn't have a lot of things. How would you correlate those two things? And, it's the same thing. All of a sudden, iPhones aren't available, and it's because we've disrupted the supply chain in some way. People don't, really correlate those things.
Yeah.
They just say, well, the economy's getting worse. We need somebody to really fix it. And they keep asking for more of a strong man to do more of that sort of thing. So it just feeds on itself. It's a vicious, spiral.
All good points, Keith. Q&A. I have four questions from my followers. The first question for you is what is the one market signal that most investors are ignoring right now, and why should they pay attention? I believe that he is talking precious metals. He didn't specify, but
I think we have a lot of people who do watch the gold basis on the monetary metal. So we published a graph of the basis and co-basis and a whole bunch of other things for free on our website. So anybody can come to monetary-metals.com. All these graphs are there. So we do have an audience that follow it, but I think most people, don't. Some people do, but most people don't. If you want to trade precious metals, you should be informed and, read a little bit about the theory of the basis and look at the graphs. And, it doesn't necessarily say the timing. There's a lot of things it doesn't say, but you should be informed. Study the basis. The silver basis, as I said right now, as the silver price has moved up, the silver basis has dropped, the co-basis has risen. That's very interesting. In gold, the basis and co-basis are flat, even though the price of gold has been rising. Again, this is the opposite of what we saw 2012 to 2018. Every time the price would rise, the basis would rise. That's not happening right now. Very, very interesting.
Yeah. Thomas wants to know what are the 5 commodities that you are most bullish on?
I guess I'd have to say I really study gold and silver. So I would say gold and silver. I'm bullish at the moment. The other commodities, not necessarily so much. If the economy is going to be slowing down, if the cost of capital is going to be falling. See, most people think prices correlate to the quantity of what they call money. But my theory, and the data supports this, is that prices tend to correlate with interest rate. So if the interest rate's coming down, there's an awful lot of marginal projects that will suddenly be green-lit to produce commodities along with everything else. So I'm not really particularly bullish on the commodity sector per se. I'm bullish on gold and silver, not because they're commodities, but because...
Jeff wants to know what is a better investment in the long run, silver miners or gold miners?
That's an interesting question. If the price of silver has more upside in it right now than gold, and that's a big F, and I'm not necessarily prepared to commit to that position. Short term, yes, but if you want to invest in a mining company, you're looking for something durable, then I would imagine silver miners, especially a silver mining pure play, should have more upside in it. But what I would say to people is that the mining sector is a difficult place for retail people to invest. I don't think I'm saying anything new or any revelations here to say that, but in addition to all the risks of a regular business, you have the geology risk, you have the price risk, metallurgy risk, you have all kinds, mine engineering, you have all kinds of things that can happen. But right now, I guess my gut, 51.49 would be silver.
Final question, how will the monetary system look in 10 years from now? That's an interesting question.
I think a couple of things. Number one, there is no paper currency that can not only replace the dollar, but come remotely close to being able to replace the dollar. Not any currency that exists, not any basket or combination of any currencies that exist, not any artificial synthetic creation, some sort of IMF, World Bank, Bancor, as Keynes wanted. I don't think anything like that can work. I don't think the other governments trust each other. As much as they don't trust or like the United States government, they don't trust or like each other even more. And that's the least of the problems for another currency to really, become big. But that said, there clearly is a need in certain parts of the world for something that isn't controlled by the U.S. government, such as the SWIFT system, because Russia is locked out of it, Iran is locked out of it, and there's trade going on, and they need something. So what I imagine is going to happen is eventually they realize it's gold. And so, if Russia wants to buy something from Iran, they put some gold bars on an airplane, send it over to Iran, and then they get, the goods and go back to Russia. And then Iran buys something from Russia and then sends the gold bars back. And after a few rounds of this, they kind of realize this is inefficient. This doesn't make a lot of sense. So maybe if you find a neutral jurisdiction And I think that jurisdiction may be Dubai. It's not Switzerland anymore. Switzerland is not the Switzerland. I think Dubai is the new Switzerland. You find a neutral jurisdiction, and if everybody agrees on the jurisdiction, it may be even the vault, operator, then all you have to do is move, the title to the bars. You just call it Brinks or whoever. It wouldn't be Brinks because Brinks is a U.S. company, but you call up the vault operator and say, just transfer these, 10 bars from our account to their account. But eventually, they're going to be seeking, if you know that you're going to be buying something in 6 months, you have to pay in 6 months. You'd like to get a return on that money in the meantime. And yes, I just did say the word money and refer to gold as money. You're going to seek a return on it. And that's where I think our company comes in, Monetary Metals. We'll offer that return. And so I think, does this happen in 10 years? I think we'll see significant forward motion and progress towards this within 10 years. That you'll start to see things being settled in gold. And, people using the float that they have, the gold they temporarily possess before they have to pay it to get a return, and that'll be financing other things, and we'll start to see a restart. I wouldn't call it a reset because it has nothing to do with the price and measured in fiat currencies, but a restart of the gold, dare I say, standard, or at least the use of gold in a more serious way than just parking it in a vault, gathering dust, waiting for its price to go up. I think that you'll see that significant progress towards that in 10 years.
Yeah. Keith, how can investors, people reach out to you and become your subscribers and find out more?
So monetary-metals.com is the website. And on Twitter, or X, I guess as they call it now, I am at Real Keith Wiener. That's KeithWeiner. There are imposters that misspell my name.
As always, a pleasure talking to you. Thank you very much for coming.
Thanks for having me.